What's up everybody? Welcome to the Stocks channel. My name is Cory and today we had another very volatile day in the stock market with all of the indices closing in the red. We're still at a very important crossroads in the market and we're at very critical support and resistance levels that we need to watch very closely. So first up, we'll start with the Nasdaq100 NDX index. So let's crack open this chart and see what's going on in the stock market today. Alright, so we're starting with the NDX because the triple Qs did pay out a dividend, which is actually affecting the price action just enough where it actually makes a difference with these levels. We closed that close on the daily chart to forming a daily lower low, and as you can tell from the NDX, that level is right around 12,799. Now this is critical because remember that bear markets consist of lower highs and lower lows, and we currently are already dealing with a lower high. You can see the resistance trend line shows that the price action is in a downtrend, but we were also in a wedge because we were also forming higher lows. But with today's price action on the Nasdaq100, we're very close to forming a lower low if we do close lower again tomorrow. Now the other thing to note is the price action was closing back above the 50 EMA, but we never fully had a confirmed bull trend in the Nasdaq100. So remember, I was calling it being a defensive bull because while the price action was starting to show some bullish indications, we did not have a confirmation bull trend with a daily higher high. So as you can tell from the daily higher high is we have a long way to go to get back above to a daily higher high level, which is right around 13,200. From today's close to a higher high level, we need to go up over 3%. Now that's still in the realm of possibility, but right now you can also see that we're breaking out of this wedge. So we did break down to the bear side and we're sitting on a very critical support level, which is the previous daily low that we have on this chart. So with today's price action and the trend, we are currently looking like we are still in a bear trend on the tech sector, which is the Nasdaq100. The price action closed below all of the moving averages, and it was one of those hot knife through butter days where we just could not hold up above any of those support levels. However, we are at that critical support level, which is the previous low. And if that level does break down, the bears are going to raid this market and we're going to see much lower prices. So I wanted to show this on the NDX because on the triple Qs, you get quite a different picture due to that dividend getting paid out. But I still want to look at the Nasdaq100 triple Qs tonight. Before we do that, I also want to do a quick update on the inverse head and shoulders, which is a bullish formation. But you can see this right shoulder is getting blown out and we never actually tested that neckline. Remember, for an inverse head and shoulders pattern, you need to break above the neckline for the pattern to play out. Otherwise, there's actually no inverse head and shoulders at all. So while it did look like we were setting up for an inverse head and shoulders, the neckline was up here around 13,300 and we never actually got to that level, nor did we break and close above that level. So if you remember back, that was the triple Qs level of 324. And as you now know, that level was never broken and closed above and we never actually retested that level. So you can see the right shoulder is falling apart. So this pattern is going out the window, so we're no longer going to continue to cover it. So now jumping over to the triple Qs, you can see on the triple Qs that it does look like we formed a lower low. Now that's a little deceiving because you can see back here on March 22nd, the triple Qs did pay out a dividend, which artificially decreases the share price. So as I showed you on the NDX, we did not actually form that lower low just yet, but on the triple Qs, we did form a lower low on the daily chart. You can see that we have lower highs and now we have that lower low. And we're in a very critical area because we closed below that strong support level at 313. Remember that 313 is an absolute battlegrounds for the triple Qs, and the bears and bulls are battling at that level to keep the price above or below. Well, as you can tell from the close, we closed decisively below that level, and we're struggling to hold up right at that support level at the daily low. Now we still do have support levels at 310, and below there is a stronger support level at 307.60, but you need to have an exit strategy. You cannot just watch the market go into free fall and never have an exit plan. It's possible the market bounces off of 310 or 307, but it's equally possible that the market doesn't bounce off those levels and it continues to go lower. If you remember back to my bear scenarios, we had the market possibly going as low as the 280s and possibly even closing the gaps that we have back around 276. So remember that it's called being a defensive bull because if the support levels start breaking down, you need to get out because it's possible the market goes into free fall and you don't want to just hold a trade and lose a bunch of money on the way down. You're much better off just taking the loss now, have that exit strategy, and be ready on when you're going to sell, either a stop loss or sell on a bounce, and then you're getting ready to either time a short position into the weakness or get ready to buy off of one of these critical support levels that are much lower. So remember, on the daily chart, we still have a bear trend and we're back to bearish price action because we're back below all of the moving averages. So you can see with the price action close, we closed well below 313. we're sitting at the previous daily low, and we still have support levels down here at 310 and 307. Now remember, you don't want to get whipsawed in this market either. You don't want to go from being a bull losing money to being a bear losing money. I want to make it perfectly clear that these are still strong support levels below, and we still do have the possibility that we have a huge bounce off of one of these levels before we go any lower. Remember that in volatile markets, you get huge swings to the upside and the downside. Don't forget, just recently back here in the beginning of March, when we had this huge sell-off and then we had that huge bounce followed by another huge sell-off followed by another huge bounce. You don't want to get whipsawed, and you don't want to switch from being a call buyer to a put buyer and lose money going in both directions. You need to decide if you're better off trading as a bear or better off trading as a bull and just master one side of the trade. It's very difficult to be a good bear and a good bull and not have a bias in either direction. So if you're good at trading to the long side, focus on trading to the long side. And if you're good at trading to the short side, then just continue to focus on trading to the short side. What I would hate to see is that you're switching to a bear just in time for a huge bounce, switching to a bull just in time for a huge drop, and then switching back to a bear just in time for another huge run up. Don't get whipsawed, because the market volatility is going to trick bears and bulls alike. I can guarantee you that there's bears getting tricked just as much as there's bulls getting tricked in this market. So that's why it's so critical to follow the price action and the trend. You need to follow the price action and the trend and not just one or the other. You can see the trend is very choppy, and we really don't have a nice bear trend or a nice bull trend in either direction. We would need to see all of these moving averages stacked to the bear side or all of the moving averages stacked to the bull side to have a nice trending market. Remember, when the moving averages are stacked, in a bull scenario, the 5 will be over the 13 over the 20, and the 20 over the 50. In the bear stack up, it's just the opposite. The 5 below the 13 below the 20, and the 20 below the 50. Right now, the 5 and the 13 are still above the 20, so we don't even have a very strong bear trend. We're more in a chop zone, and the market's just sort of chopping around in this area between triple Q's levels of 312 and 322. So it's possible we continue to chop around in this range, and that's always a possibility when the market is not in trend mode, that we just sort of go nowhere, but we have huge volatile swings in both directions. So don't get whipsawed, choose a direction, choose your strong support levels, and choose your strong resistance levels. If you're trading to the long side, you're buying on support and you're selling at resistance. And if you're a bear, then you're shorting at resistance and you're covering at support. So right now, the only support levels left that I want you to pay attention to are down here at 310 and 307.60. Below 307.60, we're fully bear on this market, and we're going much lower around triple Q's levels of 290 and 280. If we can hold above 310 and 307, it's still possible we bounce all the way back up through these levels, which will now be resistance, which are going to be right around 313 and 317. Now, if we break above 317, all of these other resistance levels are still in play, but let's focus on where we're currently at, and we're currently sitting below 313. So upside resistance is going to be 313, possibly the 20 simple moving average at 314, and then the 50 EMA and the previous resistance around 316 and 317. So now that the price action is below all of these support levels, they've now become resistance, and the bulls will have a lot of work to do to get back above these moving averages. So right now I'm favoring the bear scenarios because the price action is below all of the moving averages, and all of these moving averages are closer to trending in the bear direction and not as close to trending in the bull direction. But in the worst case scenario, just be prepared for a possible choppy market that goes absolutely nowhere and tries to whipsaw you going in either direction. So let's run through both scenarios, and in the bull scenario, we're still in this wave 2, and we're sort of just chopping around before we get into this nice trend moded wave 3. In this scenario, we can continue to chop around and go through sort of a flat correction and build out this wave 2 before the bulls can build up a trend to go into wave 3. This scenario is still in play as long as we remain above about 307.60. Now, that doesn't mean it's going to be a nice smooth ride. As you can tell, it's very choppy. But this scenario is in play as long as we continue to hold above that 307.60 level. Eventually, the bulls could find support and start building a trend back up for this wave 3, and that's where you want to wait for the confirmation close back above 324. If we get a price action close back above 324, that's the confirmation that we're fully bull on this market. Until we get a price action close above 324 and go back into a bull trend, anything is possible, including the bear scenario. So in the bear scenario, this is still just a relief rally in the grand scheme of the move to the downside. So in the downside of a bear scenario, we're eventually going to break back down below this 307 level and go all the way down to about 283. It's possible the C wave could extend and we could come all the way down to close these gaps around 276. Below 276, we have another support level around 272. So the bear scenario means we would start breaking down below support, and then we would be looking for much lower prices on a break below 297. So it's possible the C wave ends around 297 or extends down to the 280s or possibly even into the 270s. So this is the bear scenario, but don't focus too much on the bear scenario until we start breaking down below support at 310 and 307.60. It's more than likely if those levels hold up that you're never actually going to see these lower prices, because those support levels are the critical support levels that the buyers are going to step in if this market is going to remain bullish. However, on a breakdown below 307, this is the most likely scenario that's going to play out on the triple Qs. So to summarize this market, you have a bull scenario and a bear scenario, and you're going to know which one is more likely going to play out by watching the price action at critical support and critical resistance. The critical resistance level for the bulls is a break and close over 324, and the critical support level for the bears is a break and close below 307. Those levels are where I want you to bound this market, and if you're not sure what to do, just wait for a confirmation break of one of those levels. You're either waiting for a break below 307 to get bearish or a break above 324 to get bullish. Anywhere in the middle, if you're not sure what to do, is no man's land, and you're better off just staying on the sidelines until this market goes back into a trend, whether it be a bear trend or a bull trend. That's the easiest way I can break this market down, and make sure you stay on the right side of the trade. Above 324 you're bullish, and below 307 you're bearish. Next up is the S&P 500 SPY ETF, and we saw SPY also going down over 0.5% today and closing below the 20 simple moving average. So this does favor the more bearish scenario because we do have the price action breaking down below the 20 simple, which means it's possible to come back down and retest support at the 50 EMA, which is now right around 384. You can see the 5 EMA did cross below the 13 EMA, so the bullish trending is going away and we're slowly starting to build up some bearish trending. The price action closing below the 20 simple moving average is considered bearish price action, and it does mean we're likely going to retest the 50 EMA. If the bear trend builds up and we start seeing price action closing below 384, it means we could be coming all the way back down to retest the support trend lines, which are in the 360s. So as you can tell, this market is very fragile, and if these critical support levels don't hold up, it means we could be going much lower. So the critical support level on SPY is a break below 384. To the upside, we need to get back above 390, and we need to start retesting 394 and trying to break out to the upside. So on SPY, we're bullish on a break above 390, and we're bearish on a break below 384. On the Dow Jones ETF, we were flat on the day, and we basically went absolutely nowhere from open to close. We closed right where we ended up yesterday, even though we did have a much more volatile day, and we were trading above 327 at one point intraday. You can see we're still in a bull trend on the Dow Jones, and we're still well above the 20 simple moving average, which is right around 321. So the Dow Jones is actually looking very good on a day like today where there was a lot of selling in some of the other sectors. We see the Dow Jones holding up very strong and still in a bull trend with bullish price action. We're looking for support on the Dow at 322, the 20 simple moving average at 321, and the next support level below there is 320. But if we do break below 320, we're likely retesting the 50 EMA at 316. Upside resistance is $327 and $330. Remember that a lot of this volatility is due to the sector rotations, and we're still seeing weakness in the tech sector even after that nice bounce off the lows. The industrials are still holding up, and that's why the Dow Jones really didn't see a lot of selling today. We did see a lot of volume on the Dow Jones even though we went absolutely nowhere, and a lot of that volume was buying and selling, so it's really just a wash. On the Russell 2000, we went down over 2.30% today. And remember on my weekend video, I said the Russell was way too far extended and it needed to go through a correction. On a break below the 50 EMA, which was right around 218, it means we're likely coming down to that support trend line at 205. So you can see we're cutting through support levels like a hot knife through butter on the Russell 2000, and it looks like we're just a falling knife and we're going into that waterfall selling. So look for possible support on the Russell 2000 around 205. And if we break below 205, I'm looking for a gap close around 197. So the Russell 2000 is very bearish and it's too far extended on the monthly charts. So I'm not a buyer of the Russell until it cools off and we see a much deeper correction. So look for support around 205 or even in the high 190s before you even consider buying into the Russell. Upside resistance is now going to be 215 and the 50 EMA at 217. Next up is the Arkk ETF, and we see Cathie Wood is still getting absolutely destroyed on her ETFs, with the Arkk ETF going down over 5.6% today. We closed well below support at 117, and we're very close to that support level at the support trend line, which is 113. If we break below the support trend line, we could come all the way back down to the next support level at 105. Remember, Arkk is still in a bear trend and the price action is still bearish, closing below all of the moving averages. You don't want to be an Arkk bull until we see a confirmation close back above the 50 EMA, which is all the way up here at 130. Upside resistance is now 117, 124, and 130. You're much better off remaining an Arkk bear until we see the price action and the trend go back to being bullish. On the VIX, which is our fear indicator, we see the VIX going up 4.43% today and still failing to break out of that resistance level at 21.6. We see the VIX is doing exactly what the market is doing, and it's just chopping around. We're going between support and resistance levels, and we're really not breaking out decisively in either direction. We're getting closes below 20, and then we're going back above 20 and failing to break out of 21.6. So as you can tell, the market is definitely in chop mode and is trying to confuse the most people it possibly can. That's exactly what smart money's goal is they want to confuse bears and bulls alike, and they never want you to know exactly what the market's going to do. So pay very close attention to the critical support and resistance levels and follow the price action. If the VIX closes back above 21.6 and starts heading up towards 25, we're looking for more volatility and a deeper correction in this market. If the VIX can hold up around 20 and possibly even close below 20, we're looking at more bullish probabilities as fear leaves the market. Just a real quick update on the 10-year Treasury note yields is we did go down about 1.47% today. So we still see the rates slowly decreasing, which should be bullish for the stock market in the long run. As I always say though, we'll see it in the price action and we'll see it in the technical trend. If it is bullish or bearish, we're going to notice it in the price action either way. On gold, we're still hanging around the 20 simple moving average and we're stuck between support down around 1686 and the resistance level, which is our price target, around 1761. On silver, we closed below support today, which was right around 25, and we're currently holding around the previous lows around 24.7. Silver is not looking bullish, and you can see it's definitely in a bear trend and closing below support, which means it could be heading much lower. On Bitcoin, we did break out of that hourly wedge, and we're currently closing below all of the moving averages, so we do have bearish price action. There's somewhat of a support trend line that Bitcoin seems to be finding support at, but I'm not sure this is going to be enough to hold Bitcoin above, testing the 50 EMA around 50,000. Remember that Bitcoin is just like the Russell 2000 and it got way too far extended and it really needs to go through a correction. The bad news in the crypto world is a correction could be a 30 to 50% drop. So if Bitcoin closes below 50,000, I'm looking for more of a waterfall selling effect where we could easily drop 20 to 30% very quickly. So the upside reward and the downside risk is not worth it on Bitcoin, and I really can't suggest you buying at these levels. It's very risky because there is a huge downside potential for a little bit upside reward. So watch this critical support level on Bitcoin very closely around 53,000. If that level does break, you're looking for a test of 50, and if 50 can't hold up, we could be going all the way back down to about 35,000. On Amazon stock, we did test the 50 EMA yet again today, and we keep failing to break and close above that level. We closed down 1.60% and we're back around support around 30.90. Downside support levels are going to be 30.90 and 30.33. And upside resistance is still that 50 EMA around 31.50. Remember that Amazon needs to get back above the 50 EMA and start closing above that level to go back into a bull trend. On Tesla, we went down 4.82% and we're still closing below all of the moving averages and we're still in a bear trend. You're much better off remaining a Tesla bear until the price action and the trend go back to being bullish. Remember, there's no guessing, and we want to let the price action and the trend confirm that we're going back into a bull market before we get overly bullish on this stock. It could still have potentially a lot more downside, so don't do any guessing. Downside support is 618 and 550 if we break down below that level. Upside resistance is going to be right around 695 and 718. On Apple, we closed down 2% today and we're right around that support level around 120. If we continue to break down, the next support level is down here around 116. Upside resistance is going to be 123 in the 50 EMA, which is now at 125. Just like with Amazon, Apple needs to get back above 125, which is the 50 EMA, to start going back into a bull trend. On the financial sector, we went up 0.36% today, but that's still a price action close below the moving averages, and we're still developing a bearish trend. Financials could be heading back down to retest support at the 50 EMA. On the industrials, we went up about 0.73% today. We're still closing over the 20 simple moving average, and we're still maintaining a bullish trend. On the energy sector, we went up 2.5% today, but we're still in a bear trend and we're still closing below the 20 simple. You can see it's rolling over and it's starting to look like it's going negatively sloping, but we are still holding up above the positively sloping 50 EMA. On the healthcare sector, we dropped about 0.11% and we did hold up above that support level at the 50 EMA. We're slowly but surely developing some bullish momentum with the bullish trend, but we still are at a very critical support level which could break in either direction. So going back to the S&P 500, you can still see that this market is still very much at a crossroads, and we're at very critical support levels, and we're struggling to break through very critical resistance levels. It's going to be more important now more than ever to stay very focused on the price action and the most critical levels in this market. So remember, you want to watch the 50 EMA if we break below the 20 simple moving average, and you want to look for higher highs and higher lows in a bull market and lower highs and lower lows in a bear market. It's very important to stay on the right side of the trend because the trend is your friend and it'll help you stay on the right side of the trade. If the market's trending lower and you're constantly trying to hold out in a long position, you're generally going to be losing on that trade. And if the market's trending higher and you're holding short positions, you're going to be losing on that trade. So try to focus on where your critical entries are and where your critical exits are, and don't get overly greedy in this market until it goes back into some sort of trend mode. Right now, we're just chopping around and the market's doing its best to try to confuse as many people as it possibly can. You can make a lot of cases that the market's going higher, and you can make a lot of cases that the market's going lower. It's more important to stay objective and follow the critical support and the critical resistance levels. Remember, on the Stocks Channel Discord, I'm giving intraday updates to help you better navigate this market. If you're interested in joining the Stocks Channel Discord community, you can find out how to join by clicking on the link in the description of the video. So next up is our trade idea, which is still Shopify, and we saw Shopify getting absolutely destroyed today, going down 4.82%. It did look like we were well on our way to testing that price target around 1200, and then we started to see the selling kicking in, and now we're all the way back to our first buy target, which is right around 1111. Below 1111, we have another support level around 1080, and below there, another support level at 1035. Remember, the goal here is to either buy at support and sell at resistance, or short at resistance and cover at support. Remember, stay on the right side of the trade of what you do better. If you're good at shorting, then stick to that. And if you're good at trading long, then stick to that. Don't limit yourself on what you can do in this market, and focus on being on the right side of the trade, which is more important than anything. If you're interested in more Stocks Channel trade ideas, there's more weekly on the Stocks Channel Discord, which you can find out how to join by clicking on the link in the description of the video. So remember to stay disciplined and patient in this market, and always make sure you're watching those critical levels. Thanks for watching, everybody, and as always, I will see you in the next episode.